Hey everyone, I'm Tim Wills and welcome back to the channel. WeWork is a commercial real estate company that provides flexible shared workspaces for individuals and companies. It signs a long-term lease, renovates the space and then subleases them out to others on short and long-term contracts. Their road to going public though has not been easy, so let's have a look at this former startup darling. This is the second time WeWork has tried to go public. This time does seem a lot more promising, but the first time they tried was through an IPO in 2019. The IPO valued WeWork at $47 billion, and their PDS statement at the time detailed incredible growth and some pretty unbelievable statements, like being able to reduce a company's office expenses by 2/3 if they started using WeWork instead of their traditional office space. So in 2019, they were valued at $47 billion and were the largest startup in America. That IPO fell through basically because of a lack of faith from investors, and not even 2 years later, they're back at it again, this time through a SPAC with a significant downgrade in their valuation. They've been valued at $9 billion by the special purpose acquisition company BowX that has taken them public. So what makes this attempt any better than the last? I suppose it comes down to their far more realistic price tag. But in saying that, it may not be all that realistic. Their majority shareholder, SoftBank, who has an 80% stake in the company and has invested $11 billion into it, valued WeWork at $2.9 billion in May 2020, just last year. So there are a lot of different valuations going around, but in this video, we're going to look at the reasons behind the $9 billion valuation. That's the one that they're going public with the SPAC. I said before how they were incredibly bullish in their 2019 attempt to go public, and I think that's clear by their overly inflated asking price, but this time around, they're no less bullish on their growth. In fact, they're predicting to make their first quarterly profit in Q4 of this year, 2021. Let's have a look at why that seems so ridiculous though. First of all, it relies heavily on workers making it back to the office by the end of this year, before the end of this year really. That's something that's already started to happen though, to be fair, and will continue to happen so long as everything keeps tracking the way it has been. That may not be too far-fetched, but the next bit is. For the past 2 years, they've had a negative 100% EBITDA margin. On a small scale, what that looks like is, say I have a lemonade stand that sells a glass of lemonade for $1, but it costs me $2 per glass to make that lemonade. So my expenses are double my revenue. On WeWork scale though, it looks like $3.2 billion of revenue with expenses of $7 billion, translating to net losses of close to $4 billion in both 2019 and 2020. So how does a company go from posting a $3 to $4 billion loss to breaking even in under a year? To be honest, I'm unsure myself. At the end of the day, WeWork is a commercial real estate company that is locked into long-term contracts. And as a result of that, they lose the nimbleness that other tech startups and other tech companies have. So to achieve an operating profit by the end of this year, which is what they've projected, they must either halve their expenses or double their revenue. And in their own projections, they clearly state that their revenue will remain stable this year. They're not going to be increasing their revenue this year. So that means they have to halve their expenses. In 2020, they did manage to cut back on a lot of expenses. Here is what they did. Optimize cost structure. They saved $1.1 billion in functional expense savings, things like cutting back on admin, sales and marketing and other things that are generally important for a growing company. $400 million or close to $400 million in OPEX. These are variable costs that have decreased because of the far lower occupancy rates in 2020. And $200 million from renegotiating leases or exiting them entirely. I wanted to point these out because even though they're saying they've optimized their cost structure, all these expenses will creep back in throughout this year and next year. Operating expenses are variable costs, these ones here, so they'll creep back in throughout this year and next year as their customer base returns. Then you've got these two here. Well, if they want to keep growing, they're going to have to increase their footprint, so that'll reverse this $200 million here. And they're also going to have to spend more in sales and marketing to attract more clients, which is this $1.1 billion here. So they haven't really optimized their cost structure at all. They've just made some savings in 2020 when their business took a hit. That's different to optimizing your cost structure. When it comes to going public, a lot of the value is tied up in what investors and the company think they can achieve in the coming years. If their growth is overestimated, then so is their value. And after this year, 2021, their growth seems to explode according to their own projections, growing by 50% year on year. This is caused in part by their lofty EBITDA margin goal of 29% by the year 2024. So what does a 29% EBITDA margin mean? It means for every dollar they make in revenue, 29% of that is profit. That's their goal by 2024, and it's completely and utterly unrealistic. Let's break it down. Their current direct operating expenses, taken as a percentage of their membership revenue, is 109%. So if it costs me $500 to rent a desk, it's costing WeWork, on average, $545 to provide that desk to me. And that doesn't even include all the other costs like support, sales, marketing, all that. To reduce these costs, they have said they will renegotiate their lease contracts, but by how much? Sure, they may be able to get a small reduction in rent, but to even come close of achieving their goal, they'd have to get a 50% rent reduction at least, and that's near impossible. Of course, the other option is to raise the rents, but that, of course, has its own problems. And then there's another thing, and that's that 29% EBITDA margin is incredibly high for any industry, let alone real estate. I could point to countless companies that don't have these incredibly high overheads on their balance sheet, yet haven't even been able to achieve a 29% EBITDA margin. Zoom Video Communications, who everyone knows about now, their flagship product runs on the cloud, yet their EBITDA margin is 26.3%. Apple, who have a notoriously high markup on their products, only just beat it with an EBITDA margin of 30.5%, and Alphabet Inc., which owns Google, runs at just 26.34%. I don't think WeWork is a bad company. Yes, they've had a bumpy road, as with most startups, and yes, they're posting massive losses at the moment, but these are things they can fix, and I do believe one day they will be profitable. But it won't be this year, and it probably won't be next year. Their growth forecasts are unrealistic, and this has artificially pumped up their valuation. I can support their vision of how they see offices in the future, but I can't support their company with a valuation like this. WeWork is overvalued, and for me, is a terrible investment. Thanks so much for watching this video. If you liked it, please hit the like button. It costs you nothing and it helps me grow. I post videos like this every week, so I'll see you back here next time.